In 1997, two men won the Nobel Prize in economics for inventing a single equation. One equation. It fit on a napkin. It was elegant enough to frame. And for 2 decades, it had done something no formula in finance had ever done before. It took the guesswork out of pricing risk itself. Wall Street didn't just use this equation. Wall Street was built on top of it. Entire trading desks, entire hedging systems, an entire multi-trillion-dollar options market, all standing on this one piece of math. Then 1 year after that Nobel Prize was handed out, the very fund built by the men who invented it collapsed so violently, it nearly took the global financial system down with it. Same equation, same brilliant minds, complete catastrophe. So here's the question we're actually answering today. How does a formula smart enough to win a Nobel Prize also become dangerous enough to nearly break Wall Street? Stick around, because the answer isn't the math was wrong. The math was right, and that's exactly what makes this story terrifying. Before we talk about what this formula did, you need to understand the chaos it walked into. Before the 1970s, options trading was barely a real market. It was closer to a guessing game. Two people would agree on a price for the right to buy or sell a stock in the future, based on gut feeling, reputation, and rough intuition. There was no shared method, no common language. If you asked 10 traders to price the same option, you get 10 different numbers, and no way to prove any of them were right. That's a problem because if nobody can agree on what something is worth, nobody can build a real market around it. You can't hedge risk with a tool you can't price. You can't scale a market built on vibes. Then in 1973, two economists, Fisher Black and Misconception, along with a third mathematician, Robert Merton, who extended their work, cracked something that had been unsolvable for decades. They found a way to calculate the exact fair price of an option. Not a guess, not a range, a number derived from pure mathematics. And the way they did it is the part almost nobody explains properly, because it's also the part that explains everything that happened later. Here's the genius insight at the heart of this formula, and I want you to really sit with this one, because it's more elegant than people give it credit for. Black and Scholes didn't need to know what you, personally, thought the stock would do. They didn't need your risk tolerance, your gut feeling, or your appetite for gambling. That was the old way of pricing risk, subjective, emotional, unreliable. Instead, they asked a completely different question. Could you build a portfolio, using just the stock itself and cash, that behaves exactly like the option, no matter what happens to the price? And the answer was yes. By constantly adjusting how much stock and cash you hold, you can replicate an option's payoff almost perfectly. That's called dynamic replication, and it's the real engine under the hood of this entire formula. Once you can replicate something exactly, arbitrage forces the price into place. If the option costs more than the replicating portfolio, traders sell the option and buy the replica, pocketing free money until prices converge. If it costs less, they do the reverse. That pressure is what pins the option to one specific fair price. This is why the formula didn't need to guess where the market was going. It sidestepped human opinion entirely and turned pricing into pure engineering. And here's the part that connects this directly to what we talked about last time. This wasn't finance dressed up in fancy language. This was continuous time mathematics, stochastic calculus, diffusion processes, the same mathematical machinery used to describe particles jittering randomly through a fluid. Finance had quietly become physics. That single insight didn't just solve a math problem. It built the plumbing for an entire industry. Once this formula existed, something remarkable happened. It didn't just make options easier to price. It made an entire market possible that hadn't really existed before. Banks needed a fast, shared standard, and now they had one. Trading desks around the world could quote a price, and everyone was speaking the same mathematical language. Risk dashboards, hedging systems, entire departments of professional risk managers. All of this infrastructure grew directly out of one equation. This is worth pausing on because it's the least appreciated fact in the whole story. This formula didn't succeed because it perfectly described how markets behave. It succeeded because trading floors desperately needed a standard, and this was the best one available. Usefulness, not perfect truth, is what made it spread. That distinction, useful versus true, is the seed of everything that happens next. Because when a tool becomes the standard, people stop questioning it like a tool. They start trusting it like a law of nature, and laws of nature don't need double-checking. That's where the danger begins. Every powerful model is built on assumptions. That's not a flaw, that's how math works. You simplify reality just enough to make it solvable. The problem isn't that Black-Scholes made assumptions. The problem is that almost nobody using it in the real world kept asking whether those assumptions still held. Let's go through them because each one is a small crack, and small cracks under enough pressure become the whole story. Assumption 1. Stock prices move smoothly. The model assumes prices follow what's called geometric Brownian motion, a smooth, continuous random walk. No sudden jumps, no overnight shocks, but real markets gap. They crash overnight on news. They don't politely drift from one price to the next. Sometimes they fall off a cliff between one tick and the next. Assumption 2. Volatility is constant. In the model's world, how wild the market swings stays the same day after day. In the real world, volatility explodes during panic and goes quiet during calm. Treating a variable number as if it's fixed is like designing a bridge assuming the wind never changes speed. Assumption 3. Trading is frictionless. No transaction costs, no liquidity problems. You can rebalance your hedge continuously, instantly, for free. In reality, every trade costs something, and during a crisis, liquidity can simply vanish. The market where you needed to trade suddenly isn't there anymore. Assumption 4. Borrowing and lending happen at one single risk-free rate. In calm markets, that's close enough to true. In stressed credit markets, exactly when you need your hedge to work the most, borrowing costs can diverge wildly from that clean, simple assumption. Assumption 5. You can trade in perfectly fractional amounts at any moment. The model assumes infinite precision and infinite speed. Real markets have minimum trade sizes, delays, and gaps where you simply cannot execute the trade the model says you need. Individually, each of these feels like a minor simplification, a rounding error. Nothing to worry about. But here's the uncomfortable truth. These assumptions weren't just simplifications. They were the exact conditions under which the model worked perfectly. And every single one of them was most likely to break during precisely the moments that mattered most, a crisis. Now let's talk about the deepest flaw, the one that's genuinely underappreciated even today. The model assumes market returns follow something close to a normal distribution, the classic bell curve. Most of the time, prices wiggle around the middle. Extreme moves are supposed to be extraordinarily rare, but real markets have what statisticians call fat tails. Extreme crashes and extreme surges happen far more often than a bell curve would ever predict. Not slightly more often, dramatically, catastrophically more often. Think about it this way. If market crashes truly followed a clean bell curve, a crash the size of 1987's Black Monday should statistically happen once every several billion years of trading. It happened once every few decades. The math wasn't just slightly off. It was describing a different universe than the one we actually trade in. And there's a second, even sneakier problem hiding underneath all of this. Markets are reflexive. That's a fancy way of saying people react to the model itself, and that reaction changes the very prices the model was trying to measure in the first place. When everyone uses the same formula, everyone hedges the same way, at the same time in the same direction. During calm markets, that's harmless. During a crisis, it means everyone is trying to sell or buy the exact same thing at the exact same moment. The model doesn't just describe the market anymore. It starts creating the market's behavior. And the very tool built to manage risk can end up manufacturing the exact kind of correlated, extreme movement it was never designed to handle. That's not a bug hiding in the code somewhere. That's the model's own popularity turning into its own worst enemy. This is where the story stops being theoretical. Remember long-term capital management from our last video. The hedge fund founded by some of the very same Nobel-linked minds behind modern derivatives theory. This is where their story and this equation collide. LTCM's entire strategy depended on model-based pricing and convergence trades, essentially betting that prices which had drifted slightly apart would eventually snap back together, exactly as the math predicted. And for years, it worked beautifully. The models were elegant. The trades were profitable. Confidence was sky-high. But here's what elegant models don't tell you. Leverage doesn't just magnify your gains, it magnifies your errors. And when a model is only slightly wrong, high enough leverage turns a small miscalculation into a system-threatening catastrophe. In 1998, Russia defaulted on its debt. Markets didn't move the way the models assumed they would. Instead of drifting calmly and independently, assets that were supposed to be unrelated all moved together, violently in the same direction at the same time. Exactly the kind of extreme, correlated event a bell curve-shaped model was never built to survive. The fund's positions, magnified by enormous leverage, unraveled in days. Losses spiraled so fast that the Federal Reserve had to step in and organize a bailout, just to stop the collapse from tearing through the rest of the financial system. Here's the sentence that matters more than any other in this entire story. The formula wasn't wrong. The math behind Black-Scholes, behind the pricing models LTCM used, was internally consistent and beautifully constructed. What broke wasn't the equation. What broke was the belief that an elegant model was the same thing as a safe one. Let's clear up the biggest misconception, because it matters more now than ever. Black-Scholes did not cause Wall Street's failures. That's the lazy, popular version of this story, and it's simply not accurate. What actually happened is more subtle, and honestly, more useful to understand. The model gave finance an incredibly powerful machine for organizing and pricing risk. It didn't eliminate risk. It never claimed to. It simplified risk into a form that was mathematically manageable. The danger came from a very human mistake layered on top of very good math. People started treating an organized, simplified version of risk as if it were risk eliminated entirely. The model's success bred overconfidence. Overconfidence justified bigger positions. Bigger positions meant more leverage. And more leverage is fine, right up until the exact moment your assumptions quietly stop being true, and by then, it's already too late to unwind. There's a phrase for this that captures the whole tragedy in one line. The formula's greatest achievement may also have been its greatest danger. It made financial risk look more controllable than it actually was. And once something looks controllable, people stop treating it with the fear it deserves. That's not a math problem. That's a human problem wearing a math costume. So here's the takeaway I want you to actually walk away with, because this idea reaches far beyond Wall Street. Every powerful model in finance, in engineering, in medicine, in your own life works because it simplifies something impossibly complex into something usable. That's not a weakness. That's what makes any model valuable in the first place. The danger was never the simplification itself. The danger is forgetting that a simplification exists. It's mistaking a map for the territory. It's trusting the elegance of an equation more than you trust the messiness of reality. The traders and firms that survived crisis after crisis weren't the ones who had better formulas than everyone else. They were the ones who never stopped asking the uncomfortable question underneath every model they used. What happens the moment reality stops matching my assumptions? That single habit, respecting a model while never fully trusting it, is the difference between a tool that serves you and a trap that destroys you. Black-Scholes didn't break Wall Street. Confidence did. The formula simply gave that confidence somewhere powerful to stand, until the ground it was standing on turned out to be far less solid than anyone was willing to admit. If this kind of thinking, where elegant math meets messy, unpredictable reality, is what you come here for, you're in the right place. Subscribe because next week we're doing something different. We're calculating the real physics of scarcity behind Bitcoin and why it might be thermodynamics wearing a completely different costume. See you then.